Something has shifted in the global financial system. Not overnight, not with sirens and headlines, but quietly, methodically, like tectonic plates moving beneath the surface of calm waters. If you hold gold or silver, you've likely noticed. The price action has changed, the volatility patterns have changed, the conversations among serious investors have changed. And if you don't hold precious metals, you're probably wondering whether this moment represents an opportunity or just another cycle of hype that will fade like so many before it. Let me be direct with you. This video is not about predictions. It's not about making you rich by next Tuesday. It's about understanding what's happening in the currency markets, the debt markets, and the commodity markets right now in early 2025, and why these shifts matter for anyone thinking seriously about wealth preservation. I've spent decades analyzing financial markets. I've watched booms and busts. I've seen fortunes made and destroyed. And I've learned that the most important skill in finance isn't predicting the future. It's understanding cycles, recognizing patterns, and maintaining discipline when everyone else is losing theirs. Today, we're going to walk through what's happening with the US dollar, why gold and silver are responding the way they are, and what this means for you, whether you already own these assets or you're just starting to consider them. This is not financial advice. This is financial education. And by the end of this conversation, you'll understand the landscape better than most people commenting on social media or writing headlines designed to trigger your emotions. Let's begin with the foundation. The US dollar is the world's reserve currency. You know this already. But what does that actually mean in practical terms? It means that global trade is conducted primarily in dollars. It means that central banks around the world hold dollars as their primary reserve asset. It means that oil, the most critical commodity in the global economy, is priced in dollars. This status gives the United States an extraordinary privilege. We can run deficits that other countries cannot. We can borrow at rates that would be impossible for smaller economies. We can export our inflation to the rest of the world because everyone needs our currency. But privilege creates complacency, and complacency creates vulnerability. For the past several years, something has been changing in the international monetary system. Countries that were once content to hold the majority of their reserves in U.S. Treasury bonds have been diversifying. Not dramatically, not all at once, but steadily. China has been reducing its Treasury holdings. Russia moved aggressively into gold before the geopolitical tensions escalated. The BRICS nations have been discussing alternative settlement systems for trade that would bypass the dollar entirely. Now, let's be clear about what this means and what it doesn't mean. The dollar is not going to zero. The dollar is not being replaced next month. Anyone telling you that the dollar will be worthless by summer is either confused or trying to sell you something, but the dollar is losing its monopoly, slowly, incrementally, and that changes everything about how investors should think about currency risk. When a currency loses reserve status gradually, it doesn't collapse overnight. It depreciates, it becomes more volatile. It loses purchasing power relative to hard assets and commodities. And here's the part most people miss. You don't need a full collapse for gold and silver to perform extraordinarily well. You just need ongoing depreciation and rising uncertainty about the dollar's long-term stability. That's where we are right now. The Federal Reserve has been managing an impossible balancing act. On one side, inflation that refuses to return to the 2% target they've promised. On the other side, a debt load that makes sustained high interest rates economically and politically unbearable. The total U.S. national debt has now exceeded $36 trillion. Let that number sit with you for a moment. $36 trillion. The interest payments on that debt are approaching $1 trillion per year. That's not paying down the principal. That's just the interest. And those payments are consuming an increasingly large portion of federal tax revenue. What happens when a government is spending more on interest than it is on defense? More on servicing debt than on infrastructure? What happens when the political will to cut spending doesn't exist and the appetite for higher taxes is limited? The answer is simple. The currency weakens. Not because of conspiracy, not because of malice, but because of mathematics. This is the environment we're in, and this is the environment where gold and silver have historically thrived. Let's talk about what gold and silver actually are in economic terms. They are not investments in the traditional sense. They don't pay dividends. They don't generate cash flow. They don't grow earnings quarter over quarter. They are stores of value. They are monetary metals. They are the assets people turn to when confidence in paper currency begins to erode. For thousands of years, across every civilization that developed sophisticated economies, gold and silver emerged as money. Not because governments decreed it, but because they possessed the characteristics that make something useful as a medium of exchange and a store of wealth. They're scarce, they're durable, they're divisible, they're recognizable. And most importantly, they cannot be created out of thin air by a central bank. When the supply of paper currency expands faster than the economy grows, the purchasing power of that currency declines. This is not theory. This is observable reality across centuries of economic history. And when people recognize that their currency is losing value, they move into assets that hold their value: real estate, commodities, productive businesses, and precious metals. Right now, we're seeing signs that this shift is accelerating. Central banks around the world have been net buyers of gold for more than a decade. Not speculators, not retail investors panicking about headlines. Central banks, the very institutions that manage national reserves and understand currency risk better than almost anyone. They've been buying gold at the highest pace in decades. China, India, Poland, Singapore, Turkey, countries across different continents with different political systems are all doing the same thing. Why? Because they understand that diversifying away from dollar-denominated assets reduces their vulnerability to U.S. monetary policy. Now, let's talk about silver specifically, because silver often gets overlooked in these discussions. Silver is unique. It functions both as a monetary metal and as an industrial commodity. It's used in solar panels, electronics, medical equipment, batteries, and countless other applications that are essential to modern technology. The supply-demand dynamics for silver are different from gold. The above-ground stockpiles of silver have been declining for years as industrial demand has consumed more than mining can produce. And yet, silver often moves in sync with gold during periods of currency weakness because investors recognize its dual role as both a useful commodity and a store of value. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has historically averaged around 50 to 1 over long periods. There have been times when it's spiked to 80 or even 90 to 1 during periods of economic stress. When that ratio is elevated and then begins to compress, silver tends to outperform gold on a percentage basis. We've seen this pattern repeatedly throughout market history. Understanding these relationships matters because it helps you think clearly about what assets to hold and in what proportions during different market environments. Here's where most people go wrong when thinking about gold and silver. They treat them like stocks. They look at daily price movements and try to trade in and out based on momentum or news headlines. They get excited when prices spike and discouraged when prices pull back. This is exactly the wrong mental model. Gold and silver are not growth stocks. They are insurance. They are ballast. They are the portion of your portfolio that you hold precisely because you don't know what's coming next. When everything else is working, when stocks are rising and bonds are stable and the economy is humming along, gold often does nothing. It sits there. It's boring. And that's when people sell it. That's when they decide it's a dead asset and they'd rather own something exciting. Then the cycle turns. The unexpected happens. A banking crisis, a currency crisis, a geopolitical shock, a debt spiral. And suddenly, the boring asset that did nothing for years starts protecting purchasing power while everything else is declining. This happened in 2008. It happened in the 1970s. It happened during the sovereign debt crisis in Europe. It happens every time confidence in the financial system gets tested. The people who understand this hold gold and silver through the quiet periods. They don't panic sell during corrections. They don't chase rallies. They maintain a strategic allocation and rebalance when necessary. Another mistake people make is focusing exclusively on price. They see gold at $2,000 an ounce or $2,500 or $3,000, and they think in terms of that nominal number. But what matters is not the nominal price. What matters is the purchasing power relative to other assets and to the currency you earn and spend. If gold goes from $2,000 to $4,000, but the dollar loses half its value during that same period, you haven't really doubled your wealth. You've preserved it while the currency collapsed around you. This is why serious precious metals investors think in terms of ounces, not dollars. They accumulate physical metal over time. They don't obsess over whether they bought at the perfect price. They understand that the point is to own the asset, not to time it perfectly. Timing is a fool's game. Accumulation and patience are the strategies that work. And here's another truth that makes people uncomfortable. You cannot know in advance exactly when the major moves will happen. You cannot predict the specific catalyst that will trigger the next leg higher. What you can do is position yourself so that when it happens, you're not caught unprepared. You're not scrambling to buy at the top of a panic rally. You're not paying massive premiums because everyone else suddenly realized what you understood months or years earlier. The time to prepare for a storm is before the storm arrives. Once it's here, your options become limited. Let's talk about how professional investors, the kind who manage wealth for institutions and high net worth families, think about precious metals. They start with asset allocation. They don't put everything into gold and silver. They don't bet the farm on any single asset class. They determine what percentage of their portfolio should be in monetary metals based on their overall risk profile, their time horizon, and their assessment of macroeconomic conditions. For some, that's 5%. For others, it's 10 or 15%. During periods of extreme uncertainty, some will go higher. But the key is that it's a deliberate, strategic decision, not an emotional reaction. Once they've determined their allocation, they execute over time. They dollar cost average. They buy when prices are low. They continue buying when prices are high. They don't try to perfectly time the market because they know that's impossible. They also understand the difference between paper exposure and physical ownership. You can own gold through ETFs, mining stocks, futures contracts, or digital tokens. These instruments have their place, and they offer liquidity and convenience. But they are not the same as owning physical metal. Physical gold and silver in your possession or in secure storage is an asset that exists outside the banking system. It's not someone else's liability. It doesn't depend on a counterparty remaining solvent. During periods of financial stress, the distinction becomes critical. When banks are failing or currency controls are being implemented or markets are frozen, physical metal provides a level of security that paper claims cannot match. This doesn't mean you should only own physical metal, but it does mean that some portion of your precious metals allocation should be in physical form. Now let's address risk management, because this is where discipline separates successful investors from those who blow up their portfolios. Risk management means understanding what you can afford to lose. It means never using leverage to buy precious metals. It means never borrowing money to invest in assets that don't generate cash flow. Gold and silver can be volatile. They can decline 20 or 30% during corrections. If you're leveraged during that decline, you can be forced to sell at the worst possible time. The investors who succeed in precious metals are the ones who can hold through the volatility. And you can only do that if you're not overextended. Think about your allocation in terms of what you can comfortably hold for 5 years or longer without needing to access that capital. If you might need the money in 6 months, it shouldn't be in gold or silver. If you can't sleep at night when the price drops 10%, you probably own too much. This is about psychology as much as mathematics. Your portfolio should reflect not just optimal allocation on paper, but optimal allocation for your emotional resilience. Another aspect of discipline is knowing what you're trying to achieve. Are you trying to preserve wealth? Are you trying to profit from a major move? Are you hedging against a specific risk? Different goals require different strategies. If you're preserving wealth, you're thinking in decades. You're holding through entire economic cycles. You're not checking the price every day. If you're trying to profit from a move, you need to be honest with yourself about timing, about taking profits, about having an exit plan. Most people don't think clearly about their goals. They just own gold or silver because someone told them to, or because they're worried about the future. That's not a strategy. That's anxiety. A strategy means knowing why you own what you own, what conditions would make you buy more, what conditions would make you sell, and how this fits into your overall financial picture. Let's make this concrete. What does all of this mean for you right now in 2025? If you already own gold and silver, this is not the time to panic sell because prices are volatile. This is not the time to get discouraged because the move hasn't happened as fast as you wanted. The macroeconomic conditions that support higher precious metals prices are strengthening, not weakening. The debt situation is getting worse, not better. The currency pressures are increasing, not decreasing. Your job is to maintain your discipline, continue your accumulation strategy if you're still building your position, rebalance if your allocation has gotten out of line with your targets, and most importantly, don't let short-term price movements shake you out of a long-term position. Remember why you own these assets. You own them because they protect against currency debasement. You own them because they provide diversification from financial assets. You own them because history shows they preserve purchasing power over long periods. None of that has changed. If anything, it's become more relevant. If you don't own gold and silver yet, or if you own less than you think you should, this is a moment to educate yourself and develop a plan. Don't rush in and buy everything at once because you're worried you're missing the move. Don't mortgage your house to buy metal. Don't ignore your other financial responsibilities. Start with education. Understand what you're buying and why. Understand the difference between physical metal and paper exposure. Understand the tax implications in your jurisdiction. Understand where to buy, how to store, and how to verify authenticity. Then start small. Allocate an amount you're comfortable with. Buy some physical metal. Hold it. Get used to owning it. See how it feels when the price moves around. Once you're comfortable, you can increase your position over time. Dollar cost averaging into precious metals over months or years is a perfectly valid strategy, especially during periods of uncertainty. The worst thing you can do is nothing, not because the sky is falling, but because failing to diversify your currency risk when all the warning signs are flashing is a choice, and it's a choice that could prove costly. Equally bad is the opposite extreme: panic buying, over-leveraging, or putting money you can't afford to lose into volatile assets. Balance, discipline, long-term thinking. These principles apply to every investment decision, but they're especially important with precious metals because emotions run high and misinformation runs rampant. Let me be very clear about what you should not do in this environment. Do not chase price. If gold spikes 10% in a week, that is not your signal to back up the truck and buy with both hands. Parabolic moves are often followed by sharp corrections. Let the market settle. Be patient. Do not follow online gurus who promise you that gold will be $10,000 by next month or silver will hit $100 in 6 weeks. These people are selling you something, either a product, a newsletter, or their own ego. They don't care about your financial well-being. Do not use leverage or margin to buy precious metals. This cannot be emphasized enough. Leverage in non-cash flowing assets is a recipe for disaster. When volatility spikes, you will be forced to sell at the worst possible moment. Do not ignore the rest of your financial life. Precious metals are one component of a diversified portfolio. They are not a replacement for emergency savings, retirement accounts, productive investments, or proper insurance. Do not buy metals you haven't researched. There are scams in this space, overpriced coins marketed as collectibles, storage programs that turn out to be frauds, paper claims that aren't backed by actual metal. Do your homework. Do not panic sell during corrections. If you've done your allocation correctly, you should be able to hold through volatility. If a 20% drawdown makes you want to sell everything, you probably own too much. And finally, do not assume that owning gold and silver means you don't have to think about anything else. The world is complex. Your financial strategy should address multiple scenarios, multiple risks, multiple time horizons. Precious metals are powerful tools, but they are tools, not magic. We're living through a monetary transition, not a collapse, not an apocalypse, but a shift in how the global financial system operates and how currencies are valued relative to real assets. These transitions happen slowly, then suddenly. They create opportunities for those who are prepared and pain for those who are not. Your job is not to predict exactly when the major moves will happen. Your job is to understand the forces at work, position yourself intelligently, and maintain your discipline when others are losing theirs. Gold and silver have preserved wealth through every currency crisis in human history. That doesn't guarantee the future, but it provides a framework for thinking about the present. Stay informed, stay disciplined, stay rational. The crisis is here, not because I say so, but because the debt mathematics, the currency dynamics, and the policy choices of governments around the world have created conditions that favor hard assets over paper promises. How you respond to that reality will determine whether you preserve your wealth or watch it erode along with the currency you're holding. Think carefully, act deliberately, and remember that patience and preparation matter more than reacting to noise. Thank you for watching.